Major funding for these broadcasts is made possible by grants from New York Community Bank, Capital One Bank, Perfect Building Maintenance, Chase Commercial Term Lending, M&T Bank, Genova Burns. Additional support is provided by AKA Hotels, Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Collins Building Services, Connect One Bank, CPEX Real Estate Services, Cushman & Wakefield, DDG, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Friedman, Handler Real Estate Organization, HAP Investments, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, New Banks, Optimum Window Manufacturing Corp., People's United Bank, Rosewood Realty Group, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, Terra CRG, The Continuum Company, The Moynihan Group, and These Friends.
So here we are, the start of the 15th season of the Stoller Report, and we're in a time that, the stock market's been up, down, reversals, REITs are, the REIT market is down. There's a question, but, there's this positive style, and people want to be in New York City, and people are coming here, and investors are swarming here to the level that we haven't seen in years. So I today decided to bring together two dynamic CEOs of leading banks to provide their insight on where they see the market, they see the economy, what's going to happen on 2016, and what my little crystal apple says, because they're going to be here to provide this. My guests today include Joseph Ficalora, who is the president and CEO of New York Community Bank, New York Community Bank Corp., and from Wyomissing, Pennsylvania, Jay Sadu, who is the chairman and CEO of Customers Bank and Customers Bank Corp. So, Joe, since the two of you have been in banking pretty similar times in your life, how do you see the world? How do you see the economy? I mean that blip that happened in August with the stock market, people, they're not going to get their returns and everything like that. How do you see the world?
Well, there's no question that New York happens to be enjoying incredible values, and this is not uncommon. The alternative choices are not great. There are places in the world that may be more expensive than New York, but New York has literally attained some very, very, very high multiples. And the vulnerability to this very positive cycle comes from the reality that cycle turns are inevitable, and the cycle turn that's in front of us can be triggered by a confluence of many different negatives that come together to get people convinced that tomorrow's values will be lower than today's.
Both of you individuals were around for a number of cycles, and specifically the 2008 cycle that we had. And it really came quickly, the 2008, because 2007, the real estate sales were really exploding. Everything was fine. And then, over a period of 3 to 6 months, nobody realized that the banking world was terrible, that the mortgage worlds, that they were lending too much money. It's a different world today. But, we've seen recessions. Mm-hmm. How long do we see this positive world? I'm not an economist, and I know you aren't either.
I think we are going through a phase right now that technology has made such an impact on the world, and especially in the United States, because this is where the educational institutions are. And whenever you think about it, why has innovation started in U.S.? It's because of our educational institution, and this is nothing different. And technology has made New York what it is. New York, I was in Silicon Valley 2 weeks ago. I'll tell you what, you're in New York, you just sort of get a feel. And when you especially walk into buildings like WeWork, where we have one of our offices, that this is no less than Silicon Valley. And the young people in New York is the vibrancy of New York. I don't know of any young people who doesn't want to work over here. But the problem, that also creates challenges because affordability, as Joe mentioned, isn't there in New York anymore. The young people are looking for sort of like affordable luxury. Okay? You find...
Like an oxymoron.
Yeah, I know.
Okay,
that doesn't exist over here. If somebody wants to pay $1 million or $2 million for a nice luxury place, it doesn't exist in Manhattan. But because it doesn't exist in Manhattan, it creates opportunities for Brooklyn and the other boroughs. There is always. And I think what's going to happen is that you're going to see the disruptions like what happened in August. We're going to go through that phase for the next 6 to 12 months. I don't think you're going to...
So if that happens, what effect does that have on the other implications of other areas of the business cycle? One is real estate. Certain people believe, and I saw this last week, when a crowdfunding site who's now providing alternative financing for certain real estate said, forget the stock market, invest with us in this opportunity where we can lend money as an alternative lender. So, people say, I'm worried about the market each and every day. Is the stock going to go? It's like the short seller concept over there. How do we look at this if what you're saying, and I'm not disagreeing with you, is going to happen over the next 12 months? And then the bigger question that I brought up to Joe and you before, it's wonderful that both of you are lending in the multifamily and other specialty areas. But a lot of this is predicated by, as we would call, a 1031 exchange. If the government changes their rules, and there are discussions out there because they want to change these discussions with the art world and the real estate world, what effect does that have? Okay?
Massive. Tax does, in fact, impact values. Tax does impact decisions. There's no escaping the fact that 1031 exchanges have been around for a very long time. The real estate that would be most adversely affected is the greatly appreciated real estate, and therefore you would likely have the opposite occur. So values will collapse. So the city would have a serious, serious problem. The last time the city was the major owner of real estate in New York, it was driven by the reality that there weren't other buyers in the city willing to pay. So
but we brought up a discussion earlier about the exchange rate today, okay? Retailers on Fifth Avenue in Manhattan, the stretch from 43rd to 50th was secondary. The stores were second rate. You had a lot of the gift stores or other non-major essential.
Always on sale stores.
Okay, always on sale store. Today, those properties, a property recently traded on the corner of 43rd Street and Fifth Avenue for close to $900 a square foot just for the vacant land. The Crown Building on 57th Street traded the retail for $24,000 per foot. So the big question comes in, it's great that we had 56 million visitors come to the Big Apple last year. And as Jay said, there's a lot of people who want to come to New York City because this is where they want to be over here. But if we have, if people from Europe can't spend as much money in retail, these stores cannot be leased.
I think the biggest challenge for us, and why I believe over the next couple of months or maybe even years you're going to have this volatility, is because the world is engaged in some sort of a currency war, sort of. And that's dangerous because suddenly now it's not just a 3% devaluation of the yuan, but it's the 10% and the 15% devaluations of many of the Asian and the South American and Europe, and also of euro indirectly. Euro has depreciated by what?
The euro has depreciated, and let's look at China.
And ruble.
China, ruble. Look at the money that has been brought in by the Chinese to invest. The Waldorf Astoria, the Sunshine Group, buying the Baccarat Hotel for $2.2 million a room without any history. So it's the question of that. How, as a banker, as a conservative banker, how do you look at where are the opportunities for you over the next year?
To be consistent and invest in the things that we've always invested in. Cash flows that are real.
We lend to families, not to hedge funds and REITs. Okay, so you focus on what you know, what you do best. Joe and New York Community has always focused on that, and from my opinion, as a competitor of theirs for the last 25 years, we do the same thing in our business. So we say that do a few things really well. And be something unique to the customer. And that uniqueness is understanding the customer and giving them a tremendously competitive offering. At the same time, you follow through on what you say. Whether a term sheet to us and a handshake to us is as good as a contract. And that, to me, is very important in any customer relationship in a bank. Because times are tough and times are great. That's what we call cycles, but that happens. And things will, but you lend to a good borrower, you're going to get paid back. You lend into a highly leveraged transaction, the chances are you're going to get stuck. So credit quality is what differentiates banks, and that is what is unique about both of us.
But as we both say, each and every couple of years, everyone, especially you yourself, being a Pennsylvania banker coming into the New York market with customers, there are new players who are coming here. And some of them are not as disciplined as the two people I'm sitting with. So the undisciplined banker, or the banker, let's say, who's commission-oriented. I mean, the formula. When you started in banking, when did a bank officer have the opportunity to make a commission that certain, there are certain people who work for J.P. Morgan Chase Commercial Term Lending who are making $2 million a year because they're commission-oriented. It's a different world. I mean, how do you see banking with the change in the perspective of you don't need the big branches, as Jay brought up before? How many Cipriani branches are we going to have? Mm-hmm. How do you see the evolution in the next 10 years in banking for New York Community Bank and for Customers Bank?
I think both of us will be doing the same exact thing we're doing today, avoiding risk, whether the market is overheated or not. And if you're dealing with the right people, you're going to have the right result through the cycle. The cycle's inevitable. We're a cycle player, and the best people that we lend to, they're cycle players.
But don't we have to grow? Okay, part of it is, the two of you are also caught into a situation that you are a publicly traded company.
Sure.
And you have to show returns to investors. You're not a mutual savings bank like Ridgewood, okay, who's sitting there and saying, this is what I'm going to do, okay? You have BlackRock, you have other investors who are there, who Templeton or other funds,
Sure.
who like it, and they're going to say to you, where are the opportunities? Where can we?
Here's what we see. We see that we are in the risk management business, and there's no question about it. Like Joe said, we got to be able to understand the kind of businesses that we lend to, and we have a unique strategy for serving those customers. So we've decided about a third of our business is going to be multifamily, a third of our business is going to be short-term mortgage warehouse business, which is banking the mortgage companies, and a third of our business is going to be small, medium-sized business lending. Today, it's about that level anyway. So we intend to maintain it And when you have certain cycles, certain times are better to be investing in certain types of classes. And right now, we are a very balanced bank, and we intend to keep it that way.
Right. Now, one of the interesting things that happened a couple of years ago when Joe's bank bought AmTrust is that you've gone heavily into the mortgage business that Jay was talking about. And it's been a very good business, a profitable business, and risk-reward, you're not really taking any risk because you're always selling it to the government on that situation. Where, what do we look at the millennium bankers, okay, the people today, as Jay was bringing up, that he has a mobile banking site within a WeWorks, okay? WeWorks is, office sharing has been around for 50 years. There were companies, I still remember 25 years ago, I rented space at 485 Fifth Avenue in one of these spaces where I had a typewriter and a little Apple Mac.
Yep.
So these have been around. WeWorks has evolutionized this, has put it to a higher degree because people want to be more of entrepreneurs than before. But during cycles, things could change, right?
Oh, sure. Cycles, things can change, but the point of them is that this is the era of startups. This is the era of how do you use technology to differentiate yourself and provide a better product where the customer says, wow. This is an era where the large corporations in the past were the ones who could do innovation, and now it's the masses. The power of the masses in a free enterprise is unmatchable. This is, we are going through some of the best times and best era. And we believe that our economy actually is going to be, it's going to have some trouble because we are a global economy. And when other countries start to mess around with the currency like we did to get us out of the recession, everybody does it.
Right.
And so, but it's going to have some hiccups. All right, you got to be able to deal with those. But stick to your knitting, have a unique strategy, and United States economy in this technological, innovative era is going to do very well for the next 5 to 10 years. In our
I was doing some research for an upcoming show on the effect of e-commerce on bricks and mortar retail and industrial. And the research proved, and I found an article from the Harvard Business Review in 1999 discussing this subject, and now another Harvard Business Review and another article discussing this situation. E-commerce has had an effect on retail, no question. What effect has that had on the retail, on the lending of a bank like you over the years to owners of retail shopping centers?
We don't do much of that. So the consistency in what we do is we lend to people that have actual cash flows that are typically managed well and below the market. So when the market gets overheated, it has a real impact on values, but it doesn't impact what we do.
But I know specifically one of the transactions happens to be near your headquarters on Merrick Road, is that you have a grocery anchored shopping center. Mm-hmm. So because even though e-commerce has had an effect, with the Fresh Direct and even was the Amazon, people still want to go to a grocery anchored shopping centers where you have Fairway as on that situation as the situation. Where do you see the new jobs being created today?
Yeah, I think any time you have the technology create a lack of a human touch, you have an equal opportunity to create something with a human touch. The relationship-oriented and technology-oriented businesses are going to stay. The biggest jobs are going to be created in healthcare. Biggest jobs are going to be created in technology-driven simplicity, where you simplify the life and you give better experiences to the customers. And there are examples of that in every single industry. I think our industry, banking industry, is going to go through over the next 10 years probably the biggest revolution. I think the role of the branches is diminishing immensely, but the branches are not going away. Banks are still talking, while in any other industries, when you have a similar disruption, they do something about it. Okay, I think Kodak is a prime example of they were the ones who invented a digital camera and they were the ones who went broke and other people made money on that. That's what's happening in the shadow banking. The example you gave about the alternative lending is that sort of a thing. Banks need to change, but banks must focus on the risk management. And that's where we're going to change with the changing times, but we are not going to change the way we assess risk.
Here's a question for both of you. You have to have the next generation of bankers. Mm-hmm. Banking has changed, and it's a different world than when you started with a bank when you were going to high school, okay? And you, when you graduated Wilkes, to find this bank in Pennsylvania. How hard is it, and how do you attract new talent to work for these institutions, for your bank? Because you're growing. You're a $50 billion, okay, we get $49.7 billion bank.
Don't call him more than
right.
Okay, you're an $8 billion institution. How do you attract, and this is, and we discussed this in general, one of the greatest banks who's done rather well over the years is Signature. The problem that Signature has, it's a bank of older people, that many of their deposit gatherers and their other people are over 60. They're baby boomers. So where do you get that next generation of people to become the next Joe Ficalora? Okay? The same way that the Joe Movado, who was the guy from Independence originally? Movado?
No.
Something
Anyway,
with an end.
we
Okay.
understand what you're saying.
So what I'm saying, how are you going out to attract new people, and how are you going out to attract new bankers?
I think at the end of the day, if you create an environment where people like being together, you create an environment where they stay. And that's the key to building a talent over time.
That's building the talent. But what I'm saying is, how are you finding the new talent? Okay,
Because we buy them. We buy banks.
No. But what I'm saying to you is this: we got young people, okay, and unfortunately, the banks today. I mean, at one time there were credit training programs. There was a different world. People would go in. Today, if I'm going to be a banker, I want to be a Wall Street investment banker because the rewards are over there. How today do we attract good people to come to places where there's great job security and there's great opportunities and they feel comfortable under the family approach, and to new banks? How do we attract
Michael,
that?
we are attracting a lot of millennials into our company. And one of the ways we're also doing it is because we are an innovative company. You got to attract innovative people, you got to have an innovative culture, and you got to be able to show them. So yes, we have this Customers Bank, but we also created Bank Mobile. Bank Mobile is a 100% digital bank. It's not like we also offer a mobile app, but it's the same darn product you're getting in a branch, and it's got the same ridiculous fees that you're ripping people off. We have no fees whatsoever, and we're going after the young person, and we're going after the underbanked, and people love doing something. The young people today, they love working on something where they're making an impact on the society.
In a way, that's like the Ally Bank, which was the same idea. Okay, the Ally Bank was over there saying, "Hey, you want to get a higher interest rate?"
Yeah, but Ally is they are serving the people who have a lot of money to put away, and they don't want to get the 30 basis points on CDs, which is the highest rate Bank of America is paying. Ally is going after those. We are going after the students, the underbanked, the middle-income people who only keep $1,000. They can't make the $5,000, $10,000 minimums that JP Morgan Chase has. They don't want to pay $12 a month that those guys charge them for that. They don't want to pay a $32 fee, which if you do it the second time, it becomes $132. They don't want to pay all that. Okay, Americans who make less than $52,000 a year, family, spend 10%, $5,000 a year just in fees for financial services. That is the state of America. We are going to change that, and people love to work for a company that wants to change that. Right? There's an example.
So if I looked at my crystal ball for 2016, where do you see the opportunities as a banker? Where do you see the market in a year from now, and where do you see the investment sales of where people are going to come from? Right. Okay. A couple years ago, it was Abu Dhabi. It was pension funds. Then it was the sovereign wealth funds. The world changes each time we see a cycle. So where do you see your thoughts for the new year?
I'd be very cautious about the new year. The question is, have we gone through a positive cycle far enough that the confluence of negative events in the world could come together and cause a turn? And I would suggest that the risk to the future is the psychological belief that there is going to be less value than more value in the days ahead.
Let's look at this. Out of nowhere, we had in August the stock market. Then out of nowhere, this migration from everywhere in the Middle East, trying to get these people somewhere else. ISIS has been around for years, but now it like recreated itself. So you have that is one crisis. Then you have the question of this Iran and the Israeli situation. You have all of this turmoil over here in a variety of things. And then, everything's great. Unfortunately, we have not had a serious crisis, or an accident like 9/11 in 14 years. But, everything, it's like I may have a crystal apple, but it's very fragile. And that's what I'm saying.
I think I agree with Joe. You got to be very cautious in this kind of an environment. The chances of having sudden events take place, like you talked about, Michael, are real. At the same time, there are lots of positives. Like I was talking about the technological innovation, this culture that we have is very, very positive. Anytime you have a migration, in fact, Europe, to some extent, this is a blessing in disguise because Europe never had the immigration. Why is United States good? Is because they had the immigration.
So
it's
wait,
creating some young people.
No, it's bringing immigration, but the whole question on immigration is you have to have jobs to take care of the immigration that's coming here.
You have to have low-paying jobs also in economy. When you're saying is, the immigrants in the United States who are coming in, they are the ones who start off in the lowest-paying jobs. In Europe, why is the cost of living so high? Because they didn't have the people taking care of the low-paying jobs. I'm not agreeing in anything, but actually there's a sort of a silver lining to some of this, but it's got to be dealt with. Well, we are not over here to solve the world problems, and neither of us are standing for election. Otherwise, we'll be talking about our views.
But based on the stock market, which happened, and we looked at January 1st, of this year, no one would have said that we went down to 16,000 or we even hit below 16,000.
I think
no one has thought that the prime rate and the LIBOR rate would have been this for the last 6 or 7 years. We haven't seen any increases.
I think you're going to see an increase from the Federal Reserve definitely take place in September or in December, number one. Number two, I think you're going to see a reaction by the stock market, even though it's predictable to be negative as a result of that. Number three, I think, is because of those reasons, I agree completely with Joe, you got to be very cautious. And for that reason, we are very focused on watching the credit quality of our institution, and we are only lending to those folks who have a very strong cash flow. Joe and I share that culture, of credit quality. We've known each other for 20-some years, and that's what differentiates us. So we don't have a better crystal ball other than whatever you do it well, and definitely manage your risks.
So in conclusion, we're saying that I should hold securely my crystal apple and be cautiously optimistic that there are going to be changes.
Don't forget the word cautious before optimistic. It's so cautiously optimistic sometimes means I'm optimistic, but I don't want to say it. I want to say it.
Since most people consider me more on the pessimistic than the cautiously optimistic, I agree. But I think that my audience and myself have got a good feeling of where two prominent bank CEOs are really looking at where the world is. And I'm happy that you came back to help me celebrate the beginning of the 15th season.
Congratulations.
Thanks to Joe
Michael.
Ficalora and Jay Sadu, and I'll see you next week.